Good evening and welcome to the first session of our winter term money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damian Pudner, Director of the IIMR, and today we will be hosting John Greenwood. John is the founder and chief economist of International Monetary Monitor, a macroeconomic consultancy firm based in London. Prior to this, John has held several senior positions during his career, including as chief economist at Invesco, editor of Asian Monetary Monitor, and director of the Hong Kong Futures Exchange Clearing Corporation. John is well known as the architect of the linked rate system of the Hong Kong dollar. And I should mention that John is also a member of the Institute's Academic Advisory Council, for which we are very grateful.
Thank you very much, Damian. Hello, everybody. I'm delighted to be invited to give this webinar. The topic today is the case for implementing a monetary agenda at the Bank of England. And what I intend to do is, first of all, to lay out, if you like, the case for the prosecution, that is, present some contrasting periods of monetary growth and derive the conclusion from it. I'm then going to explain why the current framework used by the Bank of England does not achieve the ideals that I and other monetary economists would like to see. I'll explain some problems with their style of management, and then offer a better way to manage money and monetary policy using the quantity theory of money. And finally, I will close up with the implications of this agenda, what it means for MPC meetings, Monetary Policy Committee meetings, for the Bank of England's day-to-day operations, what it means for the Bank of England's mandate, and the reporting and accountability requirements. The underlying thesis is well captured by this quote at the bottom of this opening page, that monetary policy is not about interest rates. It is about the rate of growth of the quantity of money. And that was from Milton Friedman as long ago as 1976. And that's going to be the sort of underlying thesis or theme of this set of slides. So if we go back as far as we can in the post-war history, where the data is reasonably accessible, the period of fixed exchange rates up to 1972 in the case of the UK saw a series of experiments really with monetary management. Famously or notoriously, under the Macmillan Tory government in the period, the late 1950s and the early 1960s, there was a series of what are frequently called stop-go episodes. What I've done in this table is to list on the left-hand side the name of the Chancellor of the Exchequer, that is the finance minister, for those of you listening from abroad, the person who had responsibility for monetary and fiscal policy. In those days, the Bank of England was not independent, and there would not have been a change of bank rate without consultation, or indeed sometimes without the approval of the Chancellor of the Exchequer. You can see that this period was divided into really a go, stop, and go series of policies. I've listed some of the signature policies of each period. Those don't need to detain us for the moment. But what I want to focus on is the inflation rates in the final two columns, all measured by the Retail Price Index, the RPI, which we still have in the UK, but is no longer used for the Bank of England's policy purposes. We nowadays use a consumer price index, which is measured slightly differently. But the important point is this was a period of fixed exchange rates. And essentially what happened was that the economy would overheat. They would allow money growth to be somewhat excessive. And when the inflation rate reached something like 5 or 6%, typically there would be constraints that would come in from the balance of payments. So the balance of payments would show current account deficits or capital outflows, events of that kind, which would compel the authorities to tighten up and to slow money growth. Unfortunately, for this period, we don't have good monetary data. The only data I was able to obtain was from the IMF, and it's not consistent with later data from the Bank of England. So I haven't included it in this table. But you can see that in the 1957-58 episode, the retail price index reached 6.5%. And in the 62-64 episode, under regional modeling, the inflation rate reached 5.6%, although not until April 1965, somewhat after modeling's term of office. But at quite modest rates of inflation, there was some sort of a balance of payments crisis, some kind of a problem which required treatment. And hence the government and the Bank of England putting their foot on the brakes, slowing things down and bringing down the inflation rate. So you can see the average inflation rates in the final column in the two stop periods, the stop under Heathcote-Amery and the stop period continued under Selwyn-Lloyd, coming down to 1.5% and 2.9%. As I say, we don't have the monetary data for this period, but clearly, when the economy was allowed to surge under those go episodes, it fairly soon hit these kind of constraints, and that meant that action had to be taken to restrain aggregate demand. If we move to more recent history, and particularly these four episodes from the 1970s onwards, when we do have consistent monetary data that we can look at, I've chosen four specific episodes. The Barber boom leading up to the first oil crisis of the early 1970s, the episode of the second oil crisis in the late 1970s, early 1980s, the Lawson boom. Lawson was a Chancellor of the Exchequer, like Mr. Barber, and that's from 1988 to 1991, and most recently, the COVID pandemic period. Now, in each of those, as you can see on the left-hand side, monetary growth moved into double-digit growth rates. So M4, the measure we're using for the first three episodes, and then M4X, which excludes certain financial intermediaries, for the COVID-19 pandemic episode, all of those, we had double-digit growth of broad money. And the average growth rates were also pretty high for extended periods. Look at the period before the first oil crisis, or from 73 through 75. So that was 17.8%. The period of the second oil crisis, 79 to 83, 13.6%. And then the Lawson period, 9.2%, 1988 to 1991. And then the recent period where the average growth rate is not quite in double digits, but nevertheless is substantially higher than monetary analysis would suggest is appropriate for the UK economy. So clearly on these four occasions, when inflation became a problem, there was, I would say, excessive money growth. And the inflation problem in each episode is reported in the next two columns. Again, I've focused on the peak inflation rate using the RPI for the earlier episodes and then the CPI when it becomes available. You can see there in the third column of figures, 26.6% inflation in the first oil crisis, 21.6% in the second oil crisis, 10.4% during the Lawson boom, and then most recently 10.8% for the CPI as recently as December 2022. And average inflation rates also well above what anybody would deem to be desirable in the final column. So the case for the prosecution essentially is that every serious episode of inflation has been accompanied or preceded by excess money growth. In this graphic chart, I've highlighted each of those episodes with the blue dashed arrows for money growth, and then the solid blue arrows accompanying the retail price index for the inflation rate. And that's simply the same information, but presented graphically. Monetary growth it's not just a matter of the rate of growth, but the time period for which the money growth is rapid. So to use an analogy that Steve Hanke and I have used, it's a matter of thinking, you can think of it as water being poured into a bathtub. And so it's not just the rate of flow, but how long that rate of flow has been in progress. And the high inflation episodes, particularly the 73-4 episode of inflation, was preceded by a prolonged period of high money growth. So the periods of the next two high inflations. The latest episode of inflation saw a rapid rate of growth of money for almost 2 years. Very rapid in the first year, much slower in the second year, but nevertheless, nearly 2 years of very rapid money growth. So it's not surprising as a result of that we've had this surge in inflation. We've had a repeat, if you like, to a degree of the behavior or the pattern of money growth that we saw in some of these earlier episodes. They're not as extreme, but nevertheless, it's been followed by inflation. Conversely, we can also look at periods of low and stable inflation. I would say that each of those has followed from a period of low and stable money growth. And I've chosen two periods: the Great Moderation from the early 1990s through to the global financial crisis of 2007-8. So I've chosen the period for money growth, 1991 to 2005. And then for the inflation average on the far right-hand column, I've chosen a period starting and ending 1 year later. And similarly, for the post-global financial crisis recovery, the period 2013 to 2019 for money growth, 2014 to the start of 2020 for inflation. And not surprisingly, these averages are very substantially lower than what we had in the previous graphic chart or in the previous table. Lower money growth accompanied, resulting in much lower inflation. And indeed, for the period after the global financial crisis, an inflation rate which on average was slightly below the target 2% inflation rate that is now set for, or has been set for the Bank of England since the early 2000s. So the case then for focusing on money and controlling money is that the economy has got into trouble in the past when the authorities have allowed money growth to be too rapid, and conversely, that when money growth has been slow and stable in this sort of range of 4 to 6 or 7%, then for the most part, inflation has been under control. There are one or two episodes indicated in the footnote for this slide when the exchange rate of the pound fell very sharply, notably in the first half of 2008. Or it fell from $2 in the first half of 2008 to $1.40, $1.45, something like that in 2009, and after the housing bubble burst and the asset flow into the UK slowed abruptly. And as a result, that weakness in the exchange rate was translated into a brief episode of inflation. But I would say that that was relative prices, that was imported inflation. And I think correctly at the time, the monetary authorities looked through that inflation, confident that policy would bring inflation back down soon afterwards. So the general message then is monetary control is necessary for a satisfactory outcome for inflation. So what is it that the Bank of England is doing that is not achieving that? As those of you who follow the bank will know, their sort of signature policy tools can be summarized under the framework of an aggregate supply, aggregate demand diagram. They see their task as managing aggregate demand to keep it in line with aggregate supply, allowing the price index to rise modestly by about 2% each year. But the problem is that these concepts are very hard to quantify. Of course, you can quantify aggregate demand as nominal GDP, but aggregate supply is much more difficult. Technically, aggregate supply consists of the output of the economy, normally viewed as the product of the labor force and its quality and productivity. How do you quantify that on a short-term basis? You can't really. So the bank is constantly trying to assess what the economy is capable of supplying and attempting to manage domestic demand, aggregate demand, in such a way that it somehow meets that target. But these notions are, I have to say, pretty vague. And as a result, we can have these occasional, very significant deviations from an appropriate money growth rate. Now, among the tools that the bank uses, which I elaborated on in my presentation to the Institute's conference last November, there are two in particular, but one is the output gap and the other is the Phillips curve, a measure of these are both measures of the tightness of the relationship between aggregate demand and aggregate supply. The output gap attempts to measure the difference between what is called potential output and actual output. But as you can see from this chart, which is derived from 4 different estimates of the output gap, the OECD, the IMF, Oxford Economics, and the European Commission have in the past come up with significantly different estimates of the output gap. And these estimates have differed rather more widely when there is a major crisis. So in the period after 2008 and the period after COVID, you can see this very significant deviation. So even if this was available on a quarterly basis, which it's not, it's generally only available on an annual basis, it would be very difficult to steer monetary policy using these kinds of concepts. And the same really applies to the Phillips curve, although that's a little different because the inputs for that are monthly. But even so, it doesn't give you a handle with which to steer the economy. On the output gap, here what I've done is to compare the difference between the OECD measure and the IMF measure for a whole lot of different economies. And again, you can see across a number of leading economies, including 1 or 2 less developed economies, the differences can be very stark. Look at the difference in the far left between the IMF and OECD measures of the output gap for Japan, 2.6% in 2021. And then at the other extreme, very significant differences for countries as important as sort of Italy, Australia, the United States, and then a huge difference for the estimate for Greece. So these are not, in any sense, tools that can be used for fine-tuning or accurate steering of the economy. In practice, what the bank does is to adjust interest rates, and by so doing, it aims to either raise or lower aggregate demand. And I think they depend on this much more than they do really on the output gap or on the Phillips curve. And those are concepts to talk about. But what they actually do is to raise or lower interest rates if they judge that the economy is either overheating or is threatened with weak demand. But the problem with interest rates is that it doesn't always, changes in interest rates don't always give you the result you need. So this little table sets out what you would expect to achieve, but also in the lower part, how the wrong result can sometimes occur. So for example, suppose the bank wants to curtail aggregate demand somewhat. It would normally raise rates, perhaps by 25 basis points, in a more extreme case by 50 basis points. And they would expect the response that the demand for loans would fall, credit growth would decline, and they would leave it at that. But importantly for us, money growth would also slow, being the other side of bank credit, the other side of the bank's balance sheets. Other types of credit will also be expected to slow down. But the problem comes in the lower part of the table when you could have a situation where rates are raised, but the demand for loans is already strong, with market rates rising above the policy rate. And in that case, the demand for loans would continue to rise. The money growth would not slow. The demand for loans would continue to increase the quantity of lending, and therefore money growth on the liability side of banks' balance sheets would also continue to grow. And you don't really know whether that is the case or not. If you're MPC members, you obviously hope that raising rates will deter lending, but you can't be sure. And conversely, for lowering rates, if the situation is that demand is weakening and the bank has evidence for that in the data that it's monitoring, the demand for loans, it would lower rates, and it would expect in response to that the demand for loans would rise, that credit growth would increase, and as a consequence of that, money growth would increase. But again, they don't go as far as the consequences for money. They would simply look at what's happening to spending. But again, you can have a problem with that. Demand for loans could be very weak, and the market rates could be falling below policy rates. And in that case, cutting rates would not increase the quantity of money. And in a moment, I'll give you a specific example of that. And then in the case of not changing rates, the final column of this table, the economy could you would expect the economy to maintain a steady state growth with inflation unchanged. But in fact, it's perfectly possible for money growth to speed up or to slow down, even with no change in the policy rate, due to the underlying state of demand. So interest rates are a rather weak tool because you simply don't know what the response is going to be. And we can elaborate on this a little bit more with this. If the central bank raises rates, a successful policy in the top left-hand quadrant of this matrix, a successful policy would consist of monetary conditions tightening and money growth slowing down. And a good example of this, when the central bank leads the market, is what the Bank of Japan did at the height of the bubble in the late 1980s. They raised interest rates starting in 1989, continued raising rates through 1991. They raised them from 2.5% to 6%. This is the official discount rate, the ODR. And money growth slowed very dramatically from a growth rate of roughly 12% on the M2 measure to zero in 1991. Now, to my way of thinking, that was overdoing it. But the policy in that sense was successful in slowing growth. The problem was that they overdid it. Lower down on the same page, lower down on the same column, an example of a central bank easing monetary conditions and increasing money growth is what happened in China in 2008, 2009, and 2010. You may recall that the Chinese government announced a fiscal stimulus of 4 trillion yuan, at the time about 6% of GDP. Interestingly, the central government's budget deficit did not increase very much from that spending. Most of it was financed at provincial or local government level and funded by lending by state-owned banks. And as a result, there was a big surge in money growth. Money growth surged from 15% to 30% per year, doubling of the money growth rate. And as a result, China was really the only economy which recovered strongly in the aftermath of the global financial crisis of that period. And that was due to the fact that money growth was very vigorous. By contrast, if we go to the bottom right-hand corner, in the UK, the second example there, when the global financial crisis occurred, in the UK, interest rates were cut very drastically, down to 0.5%. But money growth also collapsed and remained very, very weak. In other words, given that there was no money growth, no acceleration in growth, and actually on the broad measure M4, money growth actually went negative for a while. The result was a very prolonged and painful period of recession with no recovery. Most commentators attribute that to the government austerity program after 2010. But I think that is incorrect. I think most of the responsibility lies with monetary policy, the fact that monetary growth was too low, and it was very difficult, therefore, for the economy to recover. Another couple of episodes in this table, in the same box in the bottom right-hand corner, I've already mentioned in the top left, the successful squeezing or tightening of monetary policy in Japan at the time of the bubble, but then they overdid it and kept money growth too tight for too long, and as a result, the Japanese economy remained in stagnation for all of the 90s. Essentially, what they did was to follow money market rates down. So the official discount rate was being continuously cut, but it was always behind market rates. And in failing to lead, the result was that money growth progressively slowed until it became negative. So the background to the problems of the Japanese economy in the early 1990s were that money growth remained negative for a prolonged period. And then closing with the top right, where the central bank is raising rates, these episodes from the Fed in 1964, 1984-85, 1994-95 are often mentioned as periods when the Fed raised rates, but that did not precipitate recessions. And the reason is that despite raising rates, they didn't intend to precipitate a recession. The economy was not overheating at the time. They were raising rates, but what often goes unnoticed or goes without comment is that in all of these episodes, money growth continued to grow rapidly. There was no slowdown in the rate of growth of money. So these two right-hand, these three episodes in the right-hand column are examples of when the central bank, so to speak, got it wrong by failing to adjust interest rates in an appropriate way to ensure there was enough money growth to fuel aggregate demand in the domestic economy. So the current operating procedures, I think, of the bank using the aggregate demand, aggregate supply framework and using interest rates leave a lot to be desired. So what's the alternative? Well, first of all, I want to give you a picture of the relationship between money and aggregate demand. So here we've got the M4 year-on-year rate of growth for the UK. And what I've done is to smooth it over 4 quarters because money growth doesn't have its effect immediately. It's spread out over time. And I've also shown the rate of growth of nominal GDP also smoothed over a 4-quarter period. And you can see that there's a pretty good relationship. And most of the time, except for the circled episodes, most of the time the money growth rate is faster than the nominal GDP growth. And the reason for that has to do with the quantity theory of money, MV equals PY, and the fact that velocity has a steady downward trend. And that steady downward trend in the UK's case since the 1990s of about 1.7% per annum, that explains the difference between the money growth rate and the nominal GDP growth rate. So here we've got a tangible number which the bank could use and a relationship that they could use to improve performance of the economy relative to the inflation target. Now, the episodes that I've circled are brief periods when either the money growth rate was brought down too abruptly, for example, in 1993, 94, 95, and therefore was, in my view, too tight. Similarly, I've already mentioned the period after 2008, so that 2010 to 2012 period when money growth was too low, a less significant period, but nevertheless a period of very slow money growth in 2018-19 after the Brexit vote, when, again, I would say that money growth was too low, but that's a less troublesome period. But in broad terms then, this is from most of this period, certainly from the early 1990s, this is the period of what we earlier called the Great Moderation, certainly up until 2009. This relationship was adequate to rely on, although there was a period of significantly faster money growth in the late 2000s, 2007, 8, 9, a time when Mervyn King, as governor of the Bank of England, referred to the puzzle of money growth being close to in double digits or close to double digits. But the MPC continuously voted not to raise rates. So how would you use this to improve policy? Well, first of all, we've got to study the relationship between money and nominal income a bit further. And what I've done in these two graphs is to show you on the left-hand side velocity for M4 from 1963 to 2022. Now, this one is not particularly stable, and it's partly not for that reason, but because M4, with including all those financial bank-like institutions, had considerable volatility, we get these very wide deviations from the trend. But fortunately, the bank developed a monetary series M4X, excluding some of those bank-like financial institutions. And that's shown in the right-hand chart as the black line with the red trend line superimposed. And the deviations there are quite modest. Obviously, the period is much more recent. Those data only became available in 2010. They were worked back to 1997, but they don't go back beyond that. Can we rely on that 1.7% annual decline in velocity to build a monetary framework? Essentially, what that's saying is, if we flip the fraction the other way around, that is, we flip the number the other way so that we have money over nominal GDP, it's saying that people tend to hold more money per unit of income as they get richer. And that number is 1.7, close to 1.7% per annum. The way you would construct a policy around that would be to adjust the elements in the quantity theory equation. So starting with MV equals YP, I put it as YP because that's the order in which things happen. Velocity is impacted first, then real income, and then prices. Change in money growth plus the change in velocity is equal to the change in real income plus the change in inflation. And what you would do is adjust money growth for each of those elements. So in the chart, we've got the actual money growth, the black line, which is the same as in the previous chart. Real GDP is deducted from it, and that leaves you with the blue line, which is, if you like, our adjusted money growth, adjusted for growth of the economy. And then you would do the same thing for trend velocity. I wouldn't use the current velocity. The right thing to do is to use the trend of velocity, because we own, it's as much as we know that tends to have a stable trend, and you wouldn't try to do it on a sort of quarter by quarter basis. But you would then adjust money growth for both real growth and the trend of velocity, and that gives you our M dash dash, the money adjusted for real income and for velocity. And then finally, if you also deduct the price target, what you should get is a money growth rate, M with the 3 dashes, a money growth rate which is close to zero. That is to say, the growth of money finances or funds the growth of income, the increase in demand for money balances, and the higher or the target inflation rate. And what you can see from that little exercise is that in the early period, the 80s and 90s, into the early 90s, money growth was too rapid. It was then on average not bad in the 90s, although it was quite fluctuating. In the early 2000s, you can see it was gradually picking up, and the inflation rate similarly. But then in the period after the GFC, after 2010, money growth was too low. It was adjusted for these items. And then most recently, money growth has been excessively high. And of course, now as the year-on-year effect is that it is now looks much lower. But that's partly because of the base effect and because of the smoothing, the 4-quarter moving average. What people say to me when I present this kind of idea is, yes, but the economy faced a real panic at the beginning of COVID. There was a real problem. There was a dash for cash, or at least a dash for safe securities. The bank needed to meet that demand. But my response to that is, well, what they should have done is something more like what the famous quotation in Bagehot's Lombard Street, what Jeremiah Harman testified to as the action of the Bank of England in the panic of 1825. He said, and I'll read the quotation, "By every possible means and in modes that we had never adopted before, we took in stock as security, we purchased exchequer bills, we made advances on exchequer bills, we not only discounted outright, but we made advances on deposits of bills of exchange to an immense amount. In short, by every possible means consistent with the safety of the bank, and we were not upon some occasions over nice." In other words, we didn't discriminate too much about the quality of the collateral. Seeing the dreadful state in which the public were, we rendered every assistance in our power. In the left-hand side of this table, I've listed those instruments that are mentioned by Jeremiah Harman in his testimony. And on the right-hand side of the table, I've listed their modern equivalents. And the unique thing about those measures is that they were all short-term securities, and they all matured within a period of time. In other words, the bank created money to meet the demand for liquidity, but after a few months or weeks or months, those instruments expired or matured, ran off the balance sheet, and the excess amount of money was removed. Instead, this time, the Bank of England has purchased almost exclusively gilts, admittedly across the spectrum of maturities, but nevertheless, it's left us with an overhang of money that has remained in the economy, and that's the source of the inflation. So if the bank was to operate in this way, how would that change things? Well, first, members of the MPC would have to consider, has broad money growth been too fast or too slow? Is the broad money growth currently consistent with hitting the inflation target over the next 2 years? And then, subject to the opinions of MPC members and subject to Bank of England staff reports on current data and the outlook, members would vote to take actions to raise, maintain, or lower broad money growth, not merely a movement of interest rates. They would presumably, I would hope they would vote on raising the rate of money growth or lowering the rate of money growth. And that would require specific actions. So they could consist of either bank rate changes and or open market operations designed to raise or lower broad money growth. Because when the central bank buys securities from non-banks, it is creating money, and conversely, when it sells securities to non-banks. Now, none of these requirements, in my view, would be inconsistent with the bank's current role in other areas as PRA regulator, banker to the government, supervisor of financial stability. We're simply tweaking the way in which it conducts monetary policy. Now, for reporting and accountability, I think the bank's remit should be amended to target not only the 2% inflation, but that should be made subject to ensuring that broad money growth does not deviate outside a quite wide range. I would say something like 2 to 8% a year to allow for flexibility. But at least then we wouldn't get double-digit rates of growth of money as we've recently had, nor would the bank be allowed to let money growth become much too slow. On accountability, as today, any deviations of the CPI inflation rate outside the 1 to 3% range would trigger a letter of explanation to the Chancellor of the Exchequer. But I would add that the bank would be required to report on a regular basis on broad money growth, i.e., for example, in its quarterly monetary policy report. And in addition, those deviations of broad money growth outside of the specified range, the 2 to 8%, would also trigger a letter to the Chancellor. So to conclude, I think it is the excess money growth during the pandemic which has resulted in the worst episode of inflation that we've had since 1990-91, so for 40 years, nearly 40 years. The backdrop to this strategic error in monetary policy is the aggregate demand, aggregate supply framework, together with the MPC's failure to focus on broad money as a key indicator. A better way to operate monetary policy is urgently needed, and I think reliance on the quantitative theory in the way that I've presented would materially advance that objective. If broad money growth was maintained in a narrow range of something like 4 to 6%, I'm not saying that that should be the new mandate. I think it should be wider than that. But there is ample empirical evidence that this would permit 1 to 2% real GDP growth, together with an inflation rate close to the 2% target. But targeting such a narrow range for M4X growth is probably not feasible in the current state of economic research, and hence the wider allowable range of 2 to 8% that I suggested. So fundamentally, I would say the bank and the MPC have been allowed too much discretion in recent years. Procedures need to be put in place to limit the Bank of England's capacity to make that kind of costly error in the future. We need measures to avoid that kind of error. The current interest rate approach to monetary policy has recently produced this massive overshoot of broad money growth on the high side, and there's a significant risk that with QT, there'll be a corresponding undershoot on the downside. The result of an overshoot on the downside would be a major setback to asset prices, followed by a more severe recession than is necessary to bring down inflation. So I will close with the quote that I opened with. Monetary policy is not about interest rates. It's about the rate of growth of the quantity of money. And with that, I will stop. And I'm sorry, I've overrun by about 10 minutes. Back to you, Damian.
Excellent. Thank you very much for that, John. A very interesting and thought-provoking presentation. And good night.
Thank you.